Hello everyone, Chad Mays here with CEM Commercial interviewing Ryan, who is with one of our many capital sources. So Ryan, you specialize in stated income and stated assets. How does that apply to mixed use and multifamily properties?
Well, basically, it's stated income, stated asset loan program being utilized to finance or refinance mixed-use property, where the property below the first level might be retail space, and the top floor could be apartment complexes. Multifamily, anything with 5 units or more is in our wheelhouse. Anything less is conventional financing.
Okay. And do you only go by debt service coverage ratio?
Well, we do primarily focus on the income producing qualities of the property because that's what contributes mostly to a commercial property's value. However, there are circumstances where, say, a property doesn't have any tenants and the borrower may want to sell the property without it being occupied. We can go by a sales approach versus an income approach, which is very unique. Many lenders that we compete with don't do that. Also, if, say, one of the main things that we really do well is for owner-occupied properties. So, for example, a retail space that's 4 units and the owner occupies one of the units, they're not paying rent, so the property is likely not to debt service. We can look at that and realize that from a common sense underwriting approach that that's not going to happen. So we look for a sales approach.
Okay. How do your combined loan to values work? What can you go up to?
Well, combined loan to value is a situation where we'll allow an owner-occupied property to be able to, in this sense, the business owner is running their business out of that property, or if it's an apartment complex, 5 units or more, they actually live there. They can go up to 90% combined loan to value. If it's a purchase transaction, they can get a seller's second, for example, to bridge the gap between the LTV value versus the 90% value.
Okay. What are your limitations on cash outs?
Well, there are very few. We really don't look at that other than we know it's improving the customer's business. Our customers have used the cash outs to purchase other property. They've looked at it to expand, hire people, pay taxes that are back taxes, renovate. As long as the property appraises out as it is today, they can take the equity out and then renovate it however they see fit. We don't ask for contractors' information or specs or engineering plans. They can also buy inventory and consolidate debt. So they can do a number of things to basically, like I said, improve their business.
So you're a lot different than banks in regards to that, the limitations.
Much so. We actually, we're very hands-off as far as that's concerned. We understand that the business owner is the one that's made their business successful. We don't need to get involved in the details of how they conduct their daily businesses.
Okay. In your introduction video, you mentioned something about permanent financing. What does that look like?
Well, again, banks tend to do loan notes, and hard money lenders want their money within 6 months to 2 years, whereas we'll amortize the loan anywhere from 15 to 30 years. It can be an adjustable rate note, but it's still amortized over that time period. We'll even allow a 30-year fixed note in some circumstances.
Okay, great. Thank you, Ryan.